Well,
Good morning. Good afternoon.
good afternoon.
How are you?
I'm good. I just came back from a nice vacation over the weekend.
How was it?
It was great. We went to Scottsdale, as you know, and we got to see my baby daughter, Tori, and her husband, and my newest grandson, Clarky.
Clarky. Oh, how cute. Yeah. Congratulations.
Yeah.
How's everyone doing?
Everybody's great, and it was super fun.
Yeah.
Super fun. And
whole
plus,
family?
warm, just Ingrid and I.
Oh, yeah.
But it was warm, it was like 90. It was so nice. I came back home and it was like,
freezing again.
More cold weather again. Ugh.
Yeah.
Anyway.
Yeah. Same here. We both took off to the desert over the weekend.
Yeah. You went to New Mexico.
New Mexico. Yeah. Love New Mexico. I think it's really underrated, actually. But it was like doomsday there. We first encountered a sandstorm with like zero visibility on the highway, and then the fires. It's so dry and windy there that there's like horrible wildfires like ravaging New Mexico right now. There's plenty of like places you can donate if you care and you want to help out, actually.
Interesting.
A lot going on there. Yeah.
New
mug to add to the collection as well. And now I have a New Mexico mug.
That's nice.
Yeah.
So welcome to A Place of Possibility. We are glad you are here. I am Richard Del Monte.
And I'm Angela Wright.
What are we talking about today, boss?
The R word. Recession.
Ooh.
Yeah. So, recession concerns are in the news big time. You're floating all over your feed, I'm sure. And many people are wondering, like, what do we make of this? Is it real? What is it going to mean for our lives and our money? And we're here with some Recession 101.
Yeah, we hope we can ease some concerns and have you be a more educated person.
Yeah, I mean, because I hear people out there, purporting to be experts saying, well, the yield curve inverted, so we're definitely having a recession.
Yeah.
And, we've had 1 quarter of negative earnings now. And so, the news and bloggers are gearing up to sell you some ad space.
Yep. And they basically scare the heck out of you and make you make a mistake in your investment decisions based on fear.
Yeah.
So hopefully we can stop you from doing that and have you make a more educated decision.
Yeah.
So let's start with some terminology. First of all, what exactly is a recession, right? Great question.
Right.
I mean, they seem really scary because they talk about, well, what if we have one recession?
Yeah. Right.
Well, let's just, so the definition of a recession is 2 consecutive quarters of negative growth in GDP, which is gross domestic product. Gross domestic product is basically the sum total of all of the economic activity in the country. So that includes everything that's produced, all the services that are rendered, and wages, right? So that's what we're looking at, and basically they're measuring it over periods of time. So we're talking about quarter by quarter. So when the economy backs up even a little bit, it could be a recession if it happens 2 consecutive quarters.
Yeah. So we're gonna do a little econ 101 here. And as we were thinking about this, I was like transported back to Dr. Scott's econ class at Chico State, 20 some odd years ago. And wow. So,
wear it proud, girl. Mine's in the 40s.
I was actually wondering if Dr. Scott is still alive or not. I don't know.
My econ teacher was a communist.
No way.
He was a guy, like a shaggy-haired guy that he would just come back from. He was a sheep farmer in Cuba.
No way.
And he was extolling the virtues of socialism and communism when we were there.
How was that happening at a public college?
I'm like, yeah, you're smoking crack, dude. I don't know what you're thinking.
Because they're so prosperous there.
Put him as the teacher.
Why would they do that?
I don't know.
Oh, how silly.
Anyway, we always had him. There was a lot of eye rolling when he was talking about economic things and stuff. Because
that is hilarious.
Obviously, he thought it was ridiculous.
No bias in that class at all.
Yeah.
Oh my gosh. Yeah. All right. Anyway, so normally, gross domestic product, we're going to call it GDP here, grows a little each quarter. And the total GDP in the US economy over the long term has been like 2 to 3% annually. But in a recession, like Richard said, instead of growing, it contracts or shrinks or declines. We'll use all of those words interchangeably here. Yeah. And that can run anywhere from 0 growth to, like negative 36% is like the worst we've had at the height of COVID. And the reason for that is the economy was literally shut down during that period. We could not produce anything. So naturally, we had a contraction. Yep. So basically, it's like the economy is getting a little bit sick, and it can range anywhere from the sniffles due to allergies all the way to like you've got COVID and you're in the ICU. So It just really depends on what's going on.
Right. Unfortunately, the ICU events are slow, or few and far between.
Right.
So, so let's talk about what basically what happens is there are always economic cycles going forward. So the economy goes through a boom period where it's growing, and then it's followed by a usually all time has been a brief bust where it just contracts. That's a normal thing. There's nothing unusual about it, nothing to be terrified about. It's just part of the cycle.
It's the economic cycle.
Right. And so the causes of the bust periods, or the times when the recessions happen, there's usually some kind of an excess that gets built up in the economy. So for example, interest rates get too high, and then credit becomes unavailable or unaffordable for borrowers like companies or individuals buying a house or whatever, and then they stop buying or investing. Or it could be the other side, like what we see right now, where interest rates get too cheap. And then everybody's borrowing, right? It's free money. Let's go get some.
Welcome to today's housing market.
Exactly.
It causes a frenzy.
Exactly. And so there's that. And then the economy could also run out of workers, for example, or they could run out of jobs. More typically, they run out of jobs, right? And so and we're seeing where there's not enough workers now.
Right.
For sure.
Yeah.
So that's kind of how that happens.
Right.
Yeah.
So like historically, since we started tracking this in the 1700s, all the way up to like the 80s, basically, the economic cycles have been really dramatic. The booms and the busts were way more pronounced. But modern technology, the advent of the internet and all of this computing that we have, has allowed businesses to, track what they need more closely. And it's also allowed government organizations like the Fed to be more predictive in what's going to happen next. And then we also have the ability to set all of this policy now that we didn't have before. So everybody from businesses to the government has their fingers more closely on the economic pulse at all times. And we don't tend to see these crazy swings anymore.
Right. And so the tools that the Fed has at its disposal, the typical ones they've had over the years is being able to control the overnight rate that banks are charged to give money to the Fed or to borrow money from the Fed to keep their balance. Banks are required to have a certain amount of reserves. And so when they have too many, they deposit it with the Fed. And when they have too little, they borrow it from the Fed. So the Fed controls that rate. And that's been the typical thing they've been able to do. But in recent years, the Fed has said, we can actually buy bonds on the open market. So corporate bonds, all the different kinds of bonds that there are, they buy them and they keep them in their portfolio, or they'll sell them. And so that actually affects longer-term interest rates, because it affects how much money is out there. It affects the money supply. So if they're buying bonds, they're taking bonds off the market and they're putting cash out there in the economy and letting it circulate. Conversely, if they're selling bonds, they're taking cash out. It's like a sponge.
Yeah.
And so that's what you were saying, credit tightening.
Yeah. You'll hear words like quantitative easing,
right.
Quantitative tightening.
Right.
That's the Fed buying and selling bonds.
Yeah. So that's how those are the tools, and they're super effective.
Well, yeah. So since like 1982, inflation has averaged 2.6% per year.
2.6.
And that's due to these policies.
Yeah.
And like, we haven't even really thought about it. Like my entire career, people have not been worried about inflation. We keep telling retirees, like, you got to plan for, a cost of living adjustment.
We do.
And, people are like, no big deal. Finally, this year, everybody's going, oh, wait, maybe we should take a look at this.
Yep. When I came of age, my first mortgage was a 16% mortgage, and money market rates were usually 20%. So we, for my generation, we're like, oh yeah, we know all about inflation and we know it's possible.
Yeah, totally.
So when we see it coming up right now, it's like, so yeah. Okay. So, all right. So because the Fed has been so successful at managing the economy, they've been the recessions have been much less severe. And then, but that excludes the so-called black swan events. Now we all know that swans are white. So a black swan is basically saying it's rare. And so those events they seemingly come out of nowhere and they cause a recession. So for example, the .com bust in 2000 and 2001, when they had all these new internet companies that came out, people were paying any amount of money for them. And they said, your earnings don't even matter anymore. It's clicks, it's eyes, and all that stuff, crazy things. And so that ended in flames, as you might imagine, and that led to a recession. And also it came with the 9/11, right? That's when that added on, made it that much worse. But then also the Great Recession of 2007 and 2009, when when the real estate market collapsed.
Mhm.
That was another one. And then, of course, the COVID recession, which was
Yeah.
only short. It was only like 2 months,
Yeah.
but it was super severe.
Mhm.
Yeah, those were you could not have predicted those, honestly.
Right. Yeah.
It was very difficult. Right.
And people always ask us, like, who decides when we're having a recession, right? Like, is it all these pundits? Or like, what happens, and how does this is actually reported? So just so you know, they're called the National Bureau of Economic Research, and they have the responsibility of determining when a recession begins and when it ends. And so, fun fact, we don't often know that we're in a recession until after it's happened, due to the nature of, the reporting happens like in the past. And so, like, for example, we just found out this morning that the economy actually contracted, so negative GDP for the first quarter of 2022. And that was, so annual 1.4% decline.
Right.
So a quarter of that. It was the actual decline for this quarter. And that was a surprise, right? Because we had this like barn burner GDP at the end of the fourth quarter in 2021.
Right.
So if we do have one more quarter of negative earning or negative GDP, we'll be considered in a recession. And it's possible, that this is what the stock market has been predicting over the last couple of months. It's been a bit of a wild ride. And our stock market is the leading indicator of this sort of a thing.
Mm-hmm. Mm-hmm. So, I guess the question, I don't feel poorer yet. Do you?
Not yet.
No, I don't think
Not yet.
many people do.
Yeah.
It's mostly you see in the papers like, oh, I should start getting worried, maybe, or not, I don't know.
Right. Well, let's talk about that.
Okay. So let's talk about the difference between a recession and a depression. Dun, 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 dun.
People ask us this all the time.
Okay.
So the real answer is a recession is when your neighbor loses their job, and a depression is when you lose your job.
Yeah, that's right. We have heard that. But jokes aside, the effects of a depression are much more severe than a recession.
Mm-hmm.
So usually you will see widespread unemployment and major pauses in economic activity. And I use the word pause liberally because it's basically a collapse of, and so you will see, for example, a recession that lasts more than 3 years, or a recession where the economic activity declines by more than 10%.
Yeah.
Those are typically some of the sign points that point to a depression.
Yeah.
But based on those numbers, those waypoints, we had a depression in the 1930s, 1929 to 1938, and we technically had one in 2020. Although no one ever says that.
Yeah,
right?
they didn't use the D
word. It was
word.
a depression, though.
Yeah.
It was severe.
Well, yeah, the market declined more than 10%.
Maybe because it was too scary. I don't know, but it was a depression.
We weren't using that word.
Short, but it was a depression.
We were already scared enough. We were all going to die.
I know, right?
Let's add a depression.
We were thinking it was going to be over in 2 weeks. We'll stay home for 2 weeks and we'll go back out. Yeah, okay.
Well, I had somebody told us we'd stay home for 2 years,
Yeah.
People would be jumping out of windows.
That's true. Yeah.
So, our history buffs will love this next part. We're going to talk a little bit about the history of recessions. And I think it's really important for people to have this perspective because it informs like what's going to happen next and what you should do.
Right.
And I think the most important takeaway is that we have had 19 noteworthy recessions since we started tracking this in the 1700s. 19.
When the Republic was started.
Yeah. Right.
19. Okay. Yeah.
And so, bottom line, we're still standing and we've grown through every single one.
I mean, they didn't kill us?
Imagine that. So, let's start talking about the 1700s because they've changed over time. So like the early major recessions in the 17 and 1800s were all caused by these like catastrophic business failures, embezzlement, and excessive land speculation, which was a huge thing back then. And the hallmark of these 4 early recessions is that the federal government had no tools to stop them. There was just like nothing that they could do. No policy in place.
Just wait for it to end.
Yeah, basically. And so the harshness and unpredictability of this is really what led to support for a national central bank. And that's how that got started.
Yep. So then we move on into the 20th century, and there were 12 recessions during that century. And we'll cover a few of the notable ones. First of all, the 1929 to 1938, which we know is the Great Depression, was actually 2 severe recessions back to back. One was from 29 to 33, and that was characterized by, I'm just reading a book about about FDR. And
what's the book called?
It's called The Glory and the Dream. It's about the history of the United States from 1929 through 1972.
Ooh.
William Manchester, fabulous. But anyway, when FDR took office in March of 1932, the banks, it was like the low point for our entire country, the worst it's ever been. The banks were all closed.
Wow.
And most of them had gone broke. Many of them had gone broke. There was no money. There was no faith. People had no money. It was terrible. They were just terrified. And FDR came in and just said, we're going to start doing crazy things and, and making up stuff as we go along. And he turned it around. Yeah. So it was pretty cool.
World War II happens.
World War II happened, right? That got us out of the Great Depression for sure. And then the next one was February to October of 1938, which was then again World War II got us out of it.
Yeah. So then the next interesting thing that happens, there's some other ones in between, but in 1949, we begin this 11-month recession. It lasts until October 1949, when unemployment peaks at 7.9%. And an interesting thing about recessions is that unemployment also often peaks at the very end of the recession. It doesn't always start with unemployment.
Right.
But this 1949 recession was caused by the Fed raising interest rates too quickly.
The Fed? Oh my God.
So this is one that, the pundits keep citing as to why we are definitely headed to recession town right now.
Yeah. But it's interesting. The Fed's only raised interest rates 0.25%, the teeniest amount ever. And they're saying they're going to do it another, 0.5% in May.
Yeah.
That's not the end of the world. That's not something that's going to cause a giant recession.
Right.
So far.
Maybe jumping the gun a little bit.
Maybe jumping the gun
worries.
just a little bit.
Yeah.
Right.
So then we have in 1960, we've got Kennedy ends a 10-month-long recession with stimulus spending. This is when we first start to see stimulus coming out. And if interesting, his opponent at the time, Nixon, blamed the recession for causing him the election.
Yeah. Yeah.
I just think it's funny.
And stimulus basically is spending more. The government borrows money and spends it in the economy to try to get more money circulating.
Yeah. We all had an experience of this, right? When we started getting checks in the middle of COVID.
Yeah.
That's a stimulus.
Sure. Many checks, right?
Mm-hmm.
Then 1973-74 was a very notable one. Most of us that are, in my age group, we remember the gas lines that happened during that period when you couldn't get gasoline and they were, odd even license plates and days and getting gas and all that stuff. But this was led by the Arab oil embargo. They basically quadrupled the price of oil. They were mad at us. And so that caused, we were much more oil dependent then than we are now. And that caused a very severe recession. And it ended up, the stock market lost a big chunk of money, like 45%.
Mm-hmm.
And Nixon also at that time in response made it worse by, instituting wage and price controls and took the country off the gold standard, which I don't know if that, I'm not necessarily sure that was a bad thing, but it ended up leading to really severe inflation. We couldn't get rid of it for many period of time. And then that was coupled with negative growth in the economy. So that was called stagflation, stagnant economy and inflation.
Yeah.
Yeah.
That was a tough period.
Yeah, it was really rough.
So then we get into the 80s.
Yep.
So we have a double whammy, 1980 and 1982, two recessions during this period. We have the first 6 months of 1980, and then the second lasted 16 months from July 81 all the way to November 1982. So the Fed, the chairman at the time was Paul Volcker, and he basically, people say caused this recession by raising interest rates to combat inflation. That sounds really familiar and scary, right? And that basically reduced business spending, right? Businesses can't borrow money to go out and spend. It's cost them too much money. So then you also have the Iranian oil embargo at this time, aggravating economic conditions even more, reducing oil supplies and driving prices up.
Right. The difference, though, it was an order of magnitude higher. Inflation was much higher. Interest rates were way higher, like 4 times higher, and it just, we're not anywhere near that point now.
Yeah, I think it's important to almost think about this like we're getting back to normalizing interest rates.
Exactly.
We've been at historic lows for a really long time.
Exactly.
We'll talk about
exactly. The economy was fine when interest rates were, 2 to 3% in money markets and things, and it wasn't the end of the world. We were doing fine.
Yeah.
So going back there isn't necessarily a bad thing.
Yeah, totally.
Right. Okay. The next recession was 1990 to 1991. And that was when we had, it was a 9-month recession. And it was started off by the crash in the savings and loan industry, where they had a bunch of loans to commercial properties and stuff that all went belly up. Remember, we had a lot of international, like Japanese investors coming in, and just they bought everything. They bought Pebble Beach, at exorbitant prices. Everything went belly up, and all the S&Ls failed. Yeah. And so that led to another economic slowdown. And also, of course, right after that, Iraq invaded Kuwait, and that again led to higher oil prices and things. And we had it was just a period of
oil just keeps showing up.
Yeah,
here.
Oil's kind of in there. Yeah.
All right. So modern day recessions, 21st century. In the first decade, we had 3 major recessions happen, and each one was worse than the one before, but for totally different reasons.
Yep. Black swans, right?
Yeah, basically.
All 3 of them were black swans.
Totally. Yeah. Start with 2001.
2001 was, it was 8 months. The first one was, I think it was 2 of them there, from March to November. And it was caused by a boom and subsequent crash of the .com. We talked about it when we started. .com tech stocks just coming on, and then the 9/11 made it worse. Yeah, and just made it go longer. Yeah. The
.com boom and burst was a really good example of the economic cycle. Big expansion, and then big contraction happening.
I mean, tech stocks were just going; they were quadrupling. It was just off the chart. Everybody thought they were going to get rich overnight.
It's kind of synonymous to some things that are going on today, where people are having these huge gains in these investments that a lot of people don't understand. There's not a lot backing that. It's very familiar.
Bitcoin.
No, I mean, and there could certainly be some value there. Like many tech companies survived that, but proceed with caution and learn from that history lesson. So fast forward to 08, 09. We have what we've dubbed the Great Recession. So it lasts from December 2007 to June 09. It's the longest contraction since the Great Depression. And this was caused by the subprime mortgage crisis. It triggers this global bank crisis. We're bailing people out. And by 08, the damage had really spread across to the global economy. This one was interesting because investors really had nowhere to go. Oftentimes when stocks are going down, you have bonds going up. And in this case, we had none of that. There was literally, you couldn't go to real estate, you couldn't go to stocks, you couldn't go to bonds. It was losses across the board. And that was one of the first times that we had seen that. It was scary.
And it got the government came to the rescue and got us out of it.
Yes, bailouts.
They provided credit because credit was locked up. In fact, remember we had the money market funds that were breaking.
Oh, breaking the buck.
Most money market funds, if you buy them, they have $1, price per share, and some of them got down to 98 cents, and it could have been worse. And the government came in and said, "We promise we are going to back those," and they also put a lot more money into the economy and just got people's confidence back up.
Yeah,
and got lending back going again. But it was scary.
It was. And you know what's interesting about that is I had forgotten about breaking the buck. I mean, it just was completely escaped my memory. But in the moment, I remember it was so terrifying. And I think that's a really good reminder. Like everything that you're reading and seeing right now, it looks really scary. In, 12 years, you will have forgotten about it.
And
it'll
be
a blip on the radar,
Yeah,
right?
Yeah,
and I think also, despite your feelings about the government, these tools that have been put in place over the decades are really keeping us on track, and they're super helpful.
Yep.
We need the government. They're there for us.
We need the government involved for sure.
Yeah.
They come in with their unlimited resources, and they kind of ride their white horse in there, and sometimes it's a black horse, but whatever. It's just they perform a function for sure.
Totally.
Yeah. Yeah.
All right. So what happened 2020?
2020, the great, the small, the short, the brief, the blink your eye and you missed it, recession.
Depression.
Yeah, the depression,
Definitely.
right. Yeah. But the economy contracted a record 31% in the second quarter. That's after falling 5% in the first quarter. So you can imagine that's 36% decline in economic activity in just a short period of time. And we lost 20.5 million jobs in that period of time. And the unemployment rate went to almost 15%. So needless to say, that caused a brief crash in the stock market, and the unemployment stayed until double digits for like 6 more months, right? But the Federal Reserve lowered interest rates to 0, and then they said we're going to keep it down there till 2023, but now keeping rates too low when the economy was starting to come back up has caused them to rethink.
Yeah, their prediction was a little long on the recovery.
Yeah. They didn't see the inflation coming.
Yeah,
for sure. Yeah. So what does it all tell us, Angela?
Here's your history lesson
Break it down for
today. Yeah. So, the average recession since before 2007 had lasted 11 months. And that's kind of going to be our gauge here. The Great Recession was 18 months. The shortest one, 2020, lasted just 2 months.
Right.
But, I think it's interesting to take a look at market performance through all this. Is we're the investment people. So, of course, we're going to put the investment lens on this. And so let's take a look at some ups and downs in the markets. And we'll take a look at 4 notable recessions and then what happened after.
Great. And so for those of you that are watching us on video, we're going to see this graph come up. And then for those of you who are listening, we're going to attach it to as an add-on to our
show notes.
Audio.
Press pause and grab those in the show notes so you can follow along.
Right, because it's really good to see. It's very instructive. This chart is very, very good. Okay, so in 1945, this was right after, we didn't mention this one, but right after the World War II, the economy took a pause, right? Because it was retooling from the war. We didn't need everything, tanks and everything else being created, bullets. So the stock market lost about 22% over 6 months during that period, 1945. But then it went up 936% over the next 15 years. Wow, amazing. In 1974, we talked about the 73-74 bear market that was caused by the Arab oil embargo. So over the stock market lost 43% over 21 months, but then it went up 844% over the next 12 years. 1987, this was, remember the crash of 87, Black Monday? Oh yeah, that caused a little brief 3-month downturn in the market, 30%. But then after that, the market was up 817% over the next 12 years. Starting to see a pattern here, right?
Yep, telling quite the story here.
And then in 2007 and 08 and 09, when we had the
Great Recession.
The Great Recession, the markets lost about 51% over 16 months, but then they went up 529% over the next 13 years. So, these things are not catastrophic. Recessions are not catastrophic to your wealth. They just aren't. You have to be able to just hold your nose and deal with it.
Yeah, kind of endure.
Yeah.
Because look at what happens afterwards.
Right.
I mean, these huge periods of expansion, right? If you just remember that the cycle does go back up again. And good to know.
Right.
And the timing of all this, we talked about the average session being
critical.
11 months. The stock market usually starts going back up 6 months before the economy turns around. It's again why we call this the leading indicator.
Right.
So if you're using a recession to decide when to get in and out of your investments, you'll always be buying and selling at the wrong time.
Exactly.
Right? Recession's coming. I'm going to go ahead and sell. Well, guess what? The stock market predicted it 3 months ago, as we literally just saw happen. And then if you're waiting for the recession, ending numbers to come out, you've already missed the stock market recovery, which happened 6 months ago. Does that make sense?
Yeah, it does. And not every stock market decline is predicting a recession, right? So sometimes they're just going down because of something else happening,
of course,
or whatever. So you can't rely on the stock market or just trying to predict it or time it or any of that stuff.
Yeah. So what should investors do?
Well, okay. So first of all, we're not prognosticators. We don't know what the market's going to do in the future. What we do know so far is that we've had we just found this out today. We actually had to rewrite the copy for this thing because yesterday we said, well, we don't know if there's going to be a recession. Well, now we know that we had 1 quarter of negative growth, slightly negative growth last quarter. So if that continues again for the next quarter, we could be seeing a recession. Mild, more than likely, it seems like. But, that's not something to be panicking about or preparing for doomsday over or selling your stocks because of that. Right. We know the average length is 11 months. A lot of times it's shorter. We're probably 3 months in right now into it. And so the markets, if they're predicting 6 months out, it's probably the market's going to start turning around sometime in the next few weeks or a couple months. Potentially, if we have an average length of a recession, if we even have one, which we don't know.
Yeah.
Right. Yep.
So, I mean, if you're point being, don't try to time this.
Don't try to time it. Right. Don't try to time it. If you're retired, make sure that you have enough money that you need for the next couple of years in safe money. Right now, as we talked in our last podcast, you can get more than 2% in safe money in treasury bills for a 1-year period of time. So there's no excuse not to have a couple of years of money in locked up, nice, safe and sound, so you can weather whatever kinds of storms may happen in the future. Right.
And if you're still working, you can take advantage of the sale in the stock market and reallocate some of your investments, or buy more stock basically. Or if you've got some money sitting in on the sidelines, now is a great time to put it in the market.
Yep, that's right.
And I think there's something that's a little bit interesting and different right now, in that, we have a contraction in our GDP, but unemployment, which is generally a big part of the story with recession, is at a 50-year low. Basically, there are 2 jobs for every 1 person looking for a job right now. And that is not indicative of a typical recession. And so if we're having one, signs kind of point to mild, right? It's basic contraction of the economy and a normal economic cycle.
It's a really abnormal situation to think when there's like all kinds of pent-up demand, people to spend money because they're flush.
Yes. So we have the most savings Americans have ever had in the history. It's in the trillions. So congratulations, America. You're finally saving money.
Right.
And that was a lot due to the pandemic. You couldn't go anywhere or do anything. And we got stimulus padding our bank accounts.
Right.
So, and then that's got like a chicken or an egg thing, right? Because as we have all of this, if you've tried to get a contractor or buy a house or book a hotel room lately, it's
all
like,
tough.
It's so much demand that prices are through the roof. And so now we have inflation.
But people are paying those prices,
because we have the money.
They want it. They've got money. So that's, and so we're in a uniquely positive situation to be able to weather any kind of a recession that might happen because we have money saved.
Yeah.
We're in good shape.
Yeah.
And so, let's see the NASDAQ. So we have the NASDAQ right now. So far, we look at where we come. So thus far in this process, the NASDAQ is down 22% since November.
That's your tech stocks.
That's your tech stocks. And some of those individual tech stocks are down, like Nvidia, for example, 45%. They're definitely in the ballpark of being, like kind of screaming buys now. People were buying them when they're twice as high. So they're definitely a buy now.
But the important thing to remember there is not much has changed in the business structure and things like that, right? Which makes them valuable.
Right, for sure. And then the S&P 500 is down 12% since January 1st when it was at its peak. So, does this seem like a good time to get out when it's down this much so far?
Have you been listening at all?
Yeah, and we're like within a few months, maybe potentially of turning around. I just think the best thing to do is just go have a cup of coffee or something. And go.
What do you think Warren Buffett's doing right now?
Warren Buffett is rubbing his hands together right now, he's romping through the detritus of all these companies that are beaten down really badly, and people are just selling them indiscriminately. And I just saw today that Facebook, it's called Meta now, right? But they're up 16% today after going down 50% this year.
Wow.
So I mean, there's a lot of there's opportunities in the market for sure. A lot more opportunity than there is downside, I think.
Yeah, of course.
It's reasonable. Yeah.
So I think the key takeaway here is, you can't reliably time your investments around recessions. And so, the age-old tale of diversification, properly controlling the risk to your own capital. And I think also, there's this idea of like macro recession, but there's also personal recessions that happen. Those are more likely, more frequent, and something that you can actually control. And what I mean by personal recession is, you get hurt and you can't work, or you have massive medical bills. Your kid changes colleges and now the tuition spikes, or your rent has gone up. These little things that happen to us are like little mini recessions. And that's where you can dig in and control a little bit more on your personal finances. And you would do well to look at that.
Yep. So just remember, kind of to tie a bow around this, recessions are normal. They are a normal part of the economic cycle. They are generally very short lasting. And don't forget the power that the Fed has, and companies also, to respond to the situation. Companies are very adept now at responding to the situations. Like, look what they did during the COVID recession. I mean, they raised with the economy shut down, 36% decline in economic activity. A year later, they're making record profits.
Yeah.
That's incredible.
We're so much more nimble than we used to be.
So much more. And the Fed has these incredible tools to help combat. We're not sitting like sitting ducks, just, well, what are we going to do? Lose everything we have? That's not going to happen. You're not going to lose everything you have unless you're like, fully invested 100% in, one small risky thing.
Of course.
Yeah. And so it's not 1792 anymore. You're right. It's just not.
No.
We especially with computer. We didn't even talk about computer technology very much, but it just gives us so much more of a, a pulse, and we
More
know,
leverage.
we know what to do. Yeah, we are much more able to control our fate than we used to be.
We have a couple questions. I think we only
do.
have time to get to one today. And thank you so much, by the way, for submitting your questions. We love them.
We do
And if we
those.
don't get to your question, just drop it in the comments and we'll respond later.
Yep.
Okay, so today is, how bad do you think inflation will get? What are we looking at here?
Yep.
Good question.
So that's a really good question, and I think it's been running around 8% so far this year. And based on the Fed's getting hardcore about it and what they're trying to do, it's probably not going to get a whole lot worse, I wouldn't think, because they're definitely signaling that they're not going to put up with higher inflation. So, but that said, towards the end of the year, there's going to be some automatic adjustments that are going to happen that are like government benefits that are tied to the economy, and tied to GDP and inflation. So like, for example, Social Security benefits, they may go up 7, 8, 9%. Next year. So that'll cause another little echo effect, but we can't really do anything about that.
Right.
But so it may have a tail on it, but it should start moderating. If you look at like what the longer term treasuries are saying, the bond market, they're saying that they expect that interest rates or not interest rates, but inflation to go back to kind of more normal levels, 2 to 3% in the future. So.
And remember, your politicians are out there like getting elected based on inflation. We're going to keep inflation low. How dare this other guy let it get so high? Yeah. So, there's a lot of pressure out there for the Fed to do something and to keep it low. I
think on the good side, the politicians now realize they have to be a little more careful with the money they're spreading around and things, because it can lead to inflation. They're not super careful. Yeah. So anyway, thank you so much for being with us. Oh, you were going to do
So, okay. Again, if you have a question, put it in the comments. We are working on a new ebook for you. So we'll be announcing that coming up soon. But of course, we still have Endless Inheritance available. If you want a copy of that, you can go to our website or click on the link on your screen if you're watching. If you'd like to book an appointment with us, we're available for a consultation, again, on our website, or click the link on your screen. If you have any questions, you can send them to info@aplaceofpossibility, or drop them in the comments wherever you might be watching this. In 2 weeks, we're going to get back to regularly scheduled programming.
Hopefully. Hopefully.
There's no more big news. And we're going to talk about college planning, which, inflation on that is ridiculous.
We may have some news, because it looks like the Biden administration is talking again about, forgiving student loans, some amount of them. So we'll see.
So thank you so much for joining us.
We appreciate it. And remember, you're invested, and so